All right. Are we rolling?
Yeah, the red light is on. We're good to go.
Okay, awesome. Welcome back everyone to another deep dive. It is Tuesday, February 24th, 2026. And today we are talking about a stock that has, well, it's basically been the talk of the town for a while now.
Oh, absolutely. You can't ignore it.
Right. Oriental Kopi, ticker symbol KOPI. And if you've been with us for a while, you might remember we actually did a deep dive on them way back when they IPO'd.
Yeah, man, that feels like a lifetime ago.
It really does. I think our previous deep dives were Oriental Kopi, the next Starbucks, and then we did the IPO analysis one.
Right. Is Oriental Kopi the next big thing? I remember we were sitting here and the IPO price was 44 cent, 0.44 ringgit.
44 cent. And we were looking at it with a healthy dose of skepticism, I think it's fair to say.
We definitely were. We were asking if it was just another hyped-up breakfast spot selling egg tarts and coffee.
Yeah, exactly. And, well, fast forward to today. The stock closed this afternoon at 1 ringgit and 34 cent, RM 1.34.
Which is just a massive, massive run-up.
It's a triple-digit gain. I mean, if you bought in on day one and just closed your eyes and held, you are probably feeling like an absolute genius right now.
You're definitely enjoying your morning coffee a bit more, that's for sure.
Right. But, and this is the big but, that brings us to our mission for today's deep dive. They just dropped their Q1 2026 financial report.
Hawk up the presses.
Exactly. And the narrative around this stock is it's starting to shift. It's moving from this pure euphoria of look how fast they can open cafes to something a bit more critical. People are starting to ask, wait a minute, can they actually sustain this valuation?
It's the classic growth stock life cycle. You have the hype phase, the expansion phase, and then eventually gravity kicks in and the fundamentals have to actually support the price.
And gravity is exactly what we need to talk about because we've got the fresh Q1 numbers, we've got all the previous quarterly results from 2025 to look back on, and we also have this incredibly detailed and honestly quite brutal analyst commentary from Aerondight Research.
Yeah, that Aerondight note was a tough read for the bulls.
It really was. So today, we're going to slice right through the hype. We're going to look at the top line, the bottom line, the strategic expansion with Paradise Group, which is a huge development, and we're going to try to answer the ultimate question. Is Oriental Kopi a genuine growth monster, or are we looking at a giant value trap?
And we can't do that without talking about the ghost in the room.
Oh, Oldtown White Coffee.
Exactly. Is Kopi just the next Old Town before it got delisted? We really need to dig into that historical comparison because it is just too similar to ignore.
We will absolutely get into the Old Town parallels, especially since so many of you listening have been sending us messages asking about exactly that. But let's start with the headline numbers from Q1 2026.
Let's do it.
So looking at the top line, the revenue, it is, well, it's a monster number.
It really is. For Q1, they reported a record revenue of 139.2 million ringgit.
RM, 139.2 million in a single quarter.
In 90 days. Selling mostly food and beverages. It's staggering velocity.
And just to give you guys the year-over-year context, if we look back at Q1 of 2025, they were at roughly 97.8 million.
97.83, yeah.
Right, so that is a year-on-year revenue increase of 42.3%.
Which in the F&B sector is practically unheard of for a company of this size. Usually you get that kind of growth when you go from one store to two stores.
Exactly, 100% growth.
Yeah.
But when you are already pulling in near 100 million a quarter to jump another 42%, that means the aggressive cafe expansion is still working.
It is. Every time they open a new door in a major mall, you see the queues. They're capturing foot traffic exceptionally well. But it's not just the cafes anymore, is it?
No, and that's a really interesting part of this report, the packaged foods segment.
The consumer packaged goods, yeah.
Right, the boxes of white coffee you see in the grocery aisles, the jars of kaya, that is really starting to pull its weight. It's not just a souvenir item anymore, it's a real revenue driver.
But here is where we need to put the brakes on the celebration.
Yeah.
The bottom line.
Right. Revenue is vanity. Profit is sanity.
I love that phrase.
Yeah.
So let's look at the sanity. Net profit came in at 17.05 million ringgit.
Which is, again, a record.
It is a record.
Right.
And if we compare it to Q1 of last year, which was 13.09 million, that is a jump of 30.2%.
30.2% profit growth is nothing to sneeze at.
No, it's not. But, and this is the twitch in my eye when I read this report, revenue went up 42%. profit only went up 30%.
Right. The rate of profit growth is lagging behind the revenue growth.
And in a hyper-growth company, you actually want to see the opposite, right? You want to see operating leverage. Exactly. Normally, as you scale, your fixed costs get diluted over a larger revenue base, so your profit should theoretically grow faster than your top line. But here, they are running faster just to stay slightly behind where they were in terms of efficiency.
Which perfectly foreshadows our discussion on margins, which we will definitely get to, because the cost of doing business is clearly going up for them.
It's the squeeze.
It's the squeeze, yes. But before we get into the operational weeds, let's talk about the valuation, because the market reaction to these numbers is fascinating. Like we said, the stock closed at RM 1.34.
Giving it a market cap of roughly 2.68 billion ringgit.
Over 2.5 billion ringgit for a coffee chain. Now, I want to bring up that Aerondight analysis because they broke this down in a way that I think every retail investor needs to hear. They focused on a metric that is honestly a bit boring, but it's the ultimate reality check.
The earnings yield.
The earnings yield. Walk us through their math on this, because when I first read it, I actually had to run the numbers myself just to make sure they weren't exaggerating.
It's sobering math. So you start with the earnings per share, the EPS. For this Q1 report, the EPS is 0.85 cent.
Less than 1 cent.
Right. Now, we know retail and F&B can have seasonal fluctuations, but let's just do a straight annualized forecast to be generous. If they maintain this exact performance for 4 quarters, you multiply 0.85 by 4.
Which gives you roughly 3.4 cents.
3.4 cent of earnings for the entire year per share. Now, you take that 3.4 cent and you divide it by the current share price of 134 cent.
And that gives you
2.54%.
2.54% earnings yield.
Exactly.
Okay, so for anyone listening who might be new to this specific metric, let's put that 2.54% into context. Why is Aerondight ringing the alarm bell over that number?
Because you have to look at your opportunity cost as an investor. If you have cash right now, you can walk into pretty much any bank in Malaysia, open a fixed deposit account, and get a completely risk-free return of about 3.6 to 3.8%.
Risk-free. Guaranteed by the government up to a certain amount.
Completely risk-free. So the hard truth that Aerondight points out is that an investor buying Kopi today is actually earning less from the company's underlying business yield than they would just leaving that cash in a boring bank account.
You are taking on equity risk, market volatility, food safety risks, execution risks, all for a 2.5% yield.
Mathematically, you are paying for the privilege of taking on risk.
It sounds completely backwards when you lay it out like that. But of course, the counterargument is the PE ratio and the growth premium. Let's look at the price-to-earnings ratio.
Right, because yield is just the inverse of PE.
Exactly. So at RM 1.34, Kopi is trading at a PE ratio of approximately 39.4 times. Let's call it basically 40 times earnings.
40 times.
How does that compare to the rest of the F&B sector?
The Malaysian F&B sector average usually hovers somewhere between 18 and 22 times earnings for established players.
So Kopi is trading at nearly double the industry standard.
It's a massive growth premium. And if you want a really stark contrast, look at a mature non-growth sector peer. Look at Sports Toto, ticker SPTOTO.
Oh, wow. Okay. Sports Toto trades at what, maybe an 8 or 9 PE?
Exactly, around 8 to 9 times. So the insight there is that investors are willing to pay 4 times more for every single ringgit of profit generated by Oriental Kopi than they are for a ringgit of profit generated by Sports Toto.
You're paying RM30 for 1 ringgit of Kopi's profit versus RM9 for Sports Toto's profit.
Right.
So we have to ask the obvious question, why? Why are people willing to pay 134? Are they just bad at math?
No, they aren't bad at math. They are playing a different game. They are paying for momentum and future pricing.
The growth premium defense.
Precisely. You have this 30% year-over-year profit jump. You have incredible retail hype. Their truly Malaysian taste campaign has been wildly successful.
Their brand recognition is off the charts right now.
It is. So the investors buying at 39 times PE, they aren't buying today's 0.85 cent EPS. They are betting that with the upcoming central kitchen, especially the international expansion, that earnings number is going to double or triple in the next 2 to 3 years.
They're buying the 2028 earnings, not the 2026 earnings.
Exactly. But, and this is the warning we have to give, that premium is fragile. If Kopi's growth rate suddenly slows down, let's say it drops from 30% to 15%, that growth premium vanishes overnight.
Because nobody pays 40 times earnings for 15%
All
growth.
right. And if that multiple contracts back to the sector average of, say, 20 times, the stock price would correct down to around 90 cents, 0.90.
Hmm.
That is what we call fair value
Hmm.
in a non-hypergrowth scenario.
That is a terrifying drop for anyone holding at 134. It really highlights how this stock is priced for absolute perfection. They cannot afford a single bad quarter.
They really can't. They're walking a tightrope.
Okay, before we dive into the operational efficiency and figure out exactly why their profit margins are getting squeezed, I want to take a quick second here. If you are enjoying this deep dive, if this kind of detailed financial breakdown helps you make better decisions, or at least makes the market make a bit more sense, please hit that like button on the video. And make sure you subscribe to the channel. It really helps us out. And it tells the algorithm that there is an audience for actual analysis, not just stock hype.
And honestly, it justifies the sheer amount of spreadsheets we had to stare at to prep for this.
So many spreadsheets. All right, let's get back into it. Segment 3 here, the margin story. We touched on this earlier, but let's put the exact numbers on the table. Gross profit margin.
Right. In Q1 of 2025, their gross profit margin was 25.9%.
Okay.
In this latest Q1 2026 report, it has dropped to 23.0%.
That is nearly a 3% contraction at the gross level.
Yes, and it trickles all the way down. The net margin is currently sitting at around 12.2%.
12.2%. So for every 100 ringgit a customer spends in the cafe, the company keeps just over 12 ringgit in actual profit.
Exactly.
Now, a 12% net margin isn't terrible for a restaurant business, but for a company trading at 40 times earnings, you'd want that margin to be expanding, not contracting. So what is causing the squeeze? Aerondight called it the expansion tax.
The expansion tax is a huge factor. Kopi is aggressively opening new locations. They're targeting 8 to 10 new outlets this year alone.
Right.
And people forget that opening a restaurant is incredibly front-loaded in terms of costs. You have to secure the lease, pay deposits, hire the staff weeks in advance, train them, do the full renovation. All of this cash is flowing out before you sell a single cup of coffee.
So the revenue from the new stores hasn't fully materialized, but the expenses hit the income statement immediately.
Precisely. That creates a natural drag on the margins during periods of hyper-expansion.
But it's not just the new stores, is it? It's the cost of running the existing ones, the labor situation.
The labor costs are the real structural headwind, and this applies to the entire F&B sector in Malaysia right now. You have minimum wage hikes, and the cost of foreign worker permits has gone up significantly.
And Oriental Kopi's business model is extremely labor-intensive.
Exactly. Think about the handmade bottleneck. Their whole brand identity revolves around fresh, high-quality local food. The egg tarts are baked fresh, the coffee is hand-pulled.
You can't just replace that with a vending machine.
No, you have kitchens full of staff mixing dough, watching ovens, brewing coffee. It requires a lot of manpower per square foot of retail space. So as labor costs rise, their margins get crushed because they haven't achieved true economies of scale on the production side yet.
Yeah, and that brings us to the holy grail of this stock's narrative, the central kitchen.
The catalyst. This is what every analyst is modeling their future earnings around.
So they are building a massive central kitchen facility in Selangor. What's the timeline on that?
It is scheduled for completion in the fourth quarter of 2026.
Q4 2026. Okay. Let's explain why this is such a game changer. How does a central kitchen fix the margin squeeze?
Right now, every single outlet is basically operating as its own independent factory. You have staff doing raw prep, mixing ingredients, making the tart shells from scratch in every single kitchen across the country.
Which means a lot of duplicate labor and probably some inconsistency.
Exactly. The central kitchen centralizes all of that heavy prep work. You mix the dough in huge industrial batches, you prepare the sauces, the kaya centrally, then you ship the semi-finished goods to the retail outlets.
So the outlets just do the final assembly and baking.
Right. It drastically reduces the footprint needed for a kitchen in a high-rent mall, and it vastly reduces the number of highly trained staff you need at each location.
You need fewer chefs and more assemblers.
Essentially, yes.
Yeah.
It brings economies of scale to their product. Once this facility is fully operational, analysts are projecting that Kopi's net margins could jump from the current 12% to maybe 18%.
18% net margin. That is a massive leap.
It is. And if they hit an 18% net margin on their current revenue trajectory, that 40 times PE ratio suddenly compresses to something Much more reasonable.
So basically, if you are buying the stock today, your entire investment thesis hinges on this factory in Selangor opening on time and working exactly as promised.
That is the bet. It's an execution bet.
Which is always risky. Construction delays, supply chain issues, equipment failures. There are 100 reasons a central kitchen could get delayed.
And if it gets delayed into 2027, the market will punish the stock price severely.
Okay, I want to pivot here because we've teased it, and I know our listeners are waiting for it. The Oldtown White Coffee
A
comparison.
historical parallel.
Yes, we had a prompt from a listener recently that literally just asked, is Kopi the next Old Town? And honestly, it's the perfect question. So let's do a little history lesson for those who might not remember. Old Town was the giant of the Malaysian coffee scene.
They absolutely dominated the market for a decade.
Let's look at the numbers. Old Town debuted on Bursa's main market in July 2011 at an issue price of RM 1.25.
Right.
And then less than 7 years later, they were gone, delisted.
Because they got bought out.
Exactly. Bought out by JDE Jacobs Douwe Egberts, the massive Dutch coffee company. Specifically, it was their indirect unit, JDE Asia. They made an offer of RM 3.18 per share.
3 ringgit and 18 sen, a fantastic exit for long-term holders.
Oh, incredible exit. The offer closed on March 20th, 2018. JDE ended up with valid acceptances for 456.8 million shares.
Which gave them a 98.6% stake in the company.
Almost complete control.
Yeah.
And the stock was officially suspended on March 28th, 2018. The total implied valuation was around RM 1.47 billion.
A massive success story for a local brand.
It really was.
Right.
So naturally, people look at Oriental Kopi, they see the white coffee, they see the local food, they see the rapid expansion, and they think, this is Old Town 2.0. I'm going to hold until Nestle or JDE buys them out for $3 billion.
It's a tempting narrative, but it misses some fundamental differences in the business models. Let's do a head-to-head comparison. Let's look at Old Town around 2017, right before the buyout, versus Kopi today in 2026.
Okay, lay it out. Let's start with the business model itself.
The biggest difference is ownership. Old Town was heavily franchised.
Meaning independent operators own the actual cafes.
Exactly. Old Town, the parent company, supplied the coffee powder, the branding, the standard operating procedures, and they collected royalty fees and supply revenues. This is a lower risk model. It requires lower capital from the parent company, but you also have less control over the individual store quality, and you don't capture 100% of the retail profit.
Okay, and Kopi.
Oriental Kopi is entirely owner-operated. They own every single cafe.
So they take on all the capital expenditure, the renovations, the rent, the payroll.
Yes, it's a high-capital, high-risk model. If a store underperforms, Kopi eats the entire loss. But on the flip side, they capture 100% of the revenue and profit from every cup of coffee sold.
It's a much more aggressive strategy. What about efficiency? How did their margins compare?
Old Town actually had slightly better gross margins back then, hovering around 26% compared to Kopi's current 23%. But Kopi absolutely destroys them on velocity.
Velocity meaning table turnover.
Table turnover, queue length, average ticket size. The sheer volume of food Kopi pushes out per square foot of retail space is much higher than a typical Old Town cafe ever would.
Which explains the massive revenue numbers. Okay, so business models are different. What about valuation? Because this is where the next Old Town thesis gets a bit shaky.
This is the crux of the issue. At its peak, as a public company, Old Town generally traded at a PE ratio of between 16 and 23 times earnings.
16 to 23.
Yes. And as we just discussed, Oriental Kopi is currently sitting at nearly 40 times earnings.
So you're paying double the multiple for Kopi today than you would have for Old Town at its absolute prime.
Exactly. So my conclusion on this comparison is that Kopi is basically Old Town on steroids. They have faster growth, arguably better modern branding, and higher volume. But they are significantly more expensive to own, and they carry a lot more operational risk because of that owner-operated model.
And there's a huge value trap warning here, right? Because Old Town, by 2017, was a mature, stable company that paid a reliable dividend.
Right, they were a cash cow.
But Kopi is a cash-hungry growth stock. They did not declare any dividend in this Q1 2026 report. All their cash is being plowed back into expansion.
And that's fine as long as the expansion works. But if execution fails, if the central kitchen stalls, or if they misjudge a new market, Kopi has a much, much longer way to fall to reach its fundamental floor than Old Town ever did.
It's the difference between falling out of a ground floor window and falling off the roof.
Precisely.
Okay, let's talk about that expansion because that is the engine of growth right now. They know they can't just keep opening cafes in the Klang Valley forever. Eventually, you run out of premium malls.
You hit market saturation.
So they have to go international, and international expansion is notoriously difficult for F&B brands. We've seen so many local heroes try to open in Jakarta or Shanghai and just bleed money until they retreat.
It is a graveyard of good intentions.
But Oriental Kopi is doing something really interesting here. They aren't going it alone. Let's talk about the strategy. First off, they have this internal guideline they call the 6-hour rule.
I love this rule. It's so pragmatic.
Yeah, explain the 6-hour rule.
It basically states that for any market within a 6-hour flight from Kuala Lumpur, Kopi will enter via a joint venture, a JV, to maintain tight quality control and operational oversight.
So Singapore, Indonesia, Thailand, Vietnam.
Right. Anything beyond 6 hours, say, the Middle East, or further into East Asia, they will rely on master franchising or direct ownership, but that's a phase 2 or phase 3 plan. Right now, the focus is the 6-hour radius.
And to execute this, they have partnered with an absolute heavyweight, Paradise Group Holdings.
This partnership is, in my opinion, the most bullish signal in the entire Q1 update.
Paradise Group is massive. For those who don't know, they run brands like Booty in the Pot, Paradise Dynasty. They have an incredible footprint in Singapore, but more importantly, they are deeply entrenched in markets that are very, very hard to crack.
Indonesia and Thailand.
Exactly. So Kopi has formed a joint venture with Paradise Group. It's a 30-70 split. Kopi owns 30%, Paradise owns 70%. Now, when I first saw that, my immediate reaction was, why are they giving away 70% of the upside? If their brand is so strong, why not own the whole thing?
It's a fair question, but you have to look at what they're actually buying with that 70% equity. They are mitigating an enormous amount of risk.
Right.
Think about what it takes to open a restaurant in Jakarta. You have to deal with complex local partner regulations, a completely different supply chain, local labor laws, getting halal certifications in a new jurisdiction, securing prime real estate in malls where you have zero relationships.
It's a nightmare. It usually takes 12 to 18 months just to get the doors open.
Exactly. Paradise Group already has the highway built into these markets. They have the mall relationships. They have the cold chain logistics. They have the local licenses.
So by partnering with them, Kopi can speed up that licensing and launch timeline from 12 to 18 months down to maybe 3 to 6 months.
Yes. And more importantly, it drastically reduces Kopi's capital risk. If the Bangkok expansion is a total flop, Kopi only eats 30% of the losses. They haven't bet the entire company's balance sheet on an unproven market.
It's a very mature strategic move. It shows that management understands their own limitations.
They know what they don't know.
Right. So what is the current status of this expansion? Where are we at right now?
Well, Singapore is the test bed, and it's already active. They started with 3 outlets, Bugis, Nex, and Westgate. And the Q1 report indicates they're expanding to 5 or more very soon.
Which is a great sign. Singapore has brutal rental rates and extreme labor shortages. If you can make the unit economics work in Singapore, you have a solid operational model.
It's trial by fire.
Yes.
And they are surviving it.
And the next stops.
The timeline points to mid-2026 for launches in Jakarta, Indonesia, and Bangkok, Thailand.
Okay, so that's the physical cafe expansion, but I want to circle back to something we touched on briefly at the start of the show because I think it ties perfectly into this international strategy. The packaged foods.
The silent winner of the Q1 report.
Yes, packaged goods are now making up about 13% of total revenue. That's huge, and you were saying earlier that this is highly exportable.
This is the real Trojan horse strategy.
Explain that. How does packaged food help the cafes?
Think about it from a brand awareness perspective. Before Kopi even signs a lease for a cafe in Bangkok, they can start distributing their boxed white coffee and jarred kaya into Thai supermarkets, 7-Elevens, and online platforms.
So they're seeding the market.
Exactly. People are buying the coffee, tasting it, getting familiar with the logo and the truly Malaysian taste branding, all before the physical store exists.
And doing that requires almost zero capital expenditure compared to building a restaurant. You're just shipping boxes.
Right. So by the time they do open that flagship cafe in Siam Paragon or Central World, they aren't an unknown foreign entity. They already have a customer base that recognizes the brand.
That is brilliant. And if that packaged goods segment continues to grow, it completely changes how we should value the company, doesn't it?
It absolutely does. If they can successfully scale the packaged goods internationally, they cease to be just a restaurant chain. They transitioned into a fast-moving consumer goods company, an FMCG,
Like a Nestle or a Unilever.
obviously on a much smaller scale, but yes, that's the business model. And FMCG companies trade at massive premiums because their product can sit on 1 million shelves across the globe simultaneously. A cafe can only serve the people who walk through its front door.
Wow. Okay, so that is the ultimate bull case for the stock.
Yes.
All right, we have covered a massive amount of ground here. We've looked at the 42% revenue growth, the 30% profit growth, the terrifying 2.5% earnings yield, the central kitchen catalyst, the Oldtown parallels, and the Paradise Group master plan. I think it is time for the verdict.
It's time for the financial moat scorecard.
Let's do it. So just to recap for the listeners, in our previous deep dive on Oriental Kopi, which was a few quarters ago, we gave them a financial moat score of 6.5 out of 10.
Right. We liked the top-line growth, but we were very cautious about the execution risk and the sheer valuation hype.
So sitting here today analyzing this Q1 2026 report, what is the new score?
I am officially upgrading the score. I am moving Oriental Kopi to a 7 out of 10. Yep.
A 7 out of 10. An upgrade. Okay, you're going to have to justify that. Despite the margin squeeze we talked about, despite the fact that it yields less than a bank deposit.
Yes, and here's my justification. It comes down to 3 things. Number 1, execution. Management said they were going to aggressively grow the top line, and they delivered 42% revenue growth. In the small cap and mid cap space, trust in management is a currency. They set a target, and they hit it.
Fair point. They are doing exactly what they promised.
Number 2, the packaged goods success. The fact that FMCG is now 13% of revenue proves that this isn't just a gimmick. They have a product that people actually want to take home. That broadens their moat significantly.
Then number 3.
The Paradise Group partnership. This is the big one for me. The JV fundamentally de-risks the most terrifying part of their growth story, which is international expansion. It turns a wild gamble into a structured, highly probable plan. That strategic maturity is worth the half-point upgrade alone.
Okay, I can see the logic there, but I have to ask, why not an 8? If the strategy is so good, why stop at 7?
The valuation drag. I simply cannot give an 8 or a 9 to a stock trading at 40 times earnings with a 12% net margin. It is priced for absolute perfection.
The concrete is still wet on the pillars supporting that 1 ringgit 34 sen price tag.
Exactly. The central kitchen must succeed in Q4. The Jakarta launch must succeed. If any of those stumble, the stock is going to get punished. It is still a very real value trap risk if growth slows down even slightly.
That is a very fair assessment. A 7 out of 10. Cautiously optimistic, but acutely aware of the price tag.
Precisely.
Well, as we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought. Something to mull over the next time you look at the ticker or walk past one of their cafes.
Let's hear it.
When you are looking at Oriental Kopi at RM 1.34, ask yourself this. Are you buying a coffee company, or are you buying a logistics company that happens to sell egg tarts?
Oh, that's a great way to frame it.
Because the future of this stock isn't the cafe on the corner in Kuala Lumpur. The future of Kopi is the box of white coffee sitting on a supermarket shelf in Hong Kong or Jakarta or Bangkok. If they can make that shift from a local restaurant to an international FMCG logistics machine, then 134 might actually be cheap in hindsight.
But if they can't make that leap and they just remain a local cafe chain, then it is wildly expensive.
Exactly. If it's a restaurant, you might want to sell. If it's a logistics company, you hold.
It's all about what you believe the end game is.
And that, my friends, is the deep dive. We have gone all the way from the 44 cent IPO days to the reality check of Q1 2026. It has been a phenomenal journey analyzing this company.
It really has. The evolution of their business model in just a few years is textbook case study material.
I want to say a massive, sincere thank you to everyone who tuned in, especially to the learner who prompted that great Oldtown comparison. We know that digging into PE ratios and earnings yields isn't quite as satisfying as eating a fresh egg tart, but we promise you, understanding these numbers will save you a lot of money and stress in the long run.
Absolutely. The best defense against market hype is knowing how to read a balance sheet.
Now, we want to hear from you. Seriously, take a second and scroll down to the comments. Tell us your thoughts. Are you a believer in the central kitchen plan, or are you a skeptic? Do you think Kopi is going to surpass Oldtown, or is this just a value trap waiting to snapshot?
And let us know what you think of that Paradise Group deal. Was it a brilliant move to give up 70% equity, or did they give away too much of the pie?
Drop your thoughts in the comments. We really do read them all, and it sparks great conversations for future deep dives. And of course, a gentle reminder. If you found value in this breakdown today, please hit that like button.
And make sure you subscribe so you don't miss our next deep dive. We've got a lot more companies to tear apart.
We certainly do. Thank you all again for listening. Keep analyzing, stay sharp, and we will see you in the next deep dive.